Let's talk personal credit scores in business. Did you know that your personal credit score will affect your business's ability to borrow money? In this video, I'm going to go over what business credit score is, how your personal credit score affects your business borrowing, and what certain codes that lenders look for that sends red flags when they're looking to make a decision to lend you money. At the end of the video, I'm going to let you know how to make sure you're in the best possible position to borrow money for your business. When it comes to your business, whether you're a new business or an existing business with many years of sales history and lending, the bank is still going to look at your personal credit score when you borrow money. Personal credit scores rank your creditworthiness based on your individual purchase history and credit history. Business credit scores do very similar things to small businesses. Personal credit scores can range from 300 to 850. Business credit scores range from 0 to 100. As your business grows, you're also going to gain a business credit score known as an SBSS. There's a huge difference between your business credit score and your personal FICO score, and if you try and compare the two, you're probably going to get frustrated because they don't always correlate. According to a study published in the Wall Street Journal, as many as 25% of business credit reports may contain errors or missing key information. If the credit report contains these mistakes, then the scores that they're produced, it's not going to accurately reflect your business. There are some popular credit scoring services such as Dun & Bradstreet, IntelliScore from Experian, FICO Liquid Credit Small Business Scoring Service, and Equifax Business Delinquency Risk Score. All of these reporting services do is essentially the same thing. They report on the creditworthiness of your business. The way that they use these business credit scores, lenders and creditors need to have a means of determining how well your business repays its debts. The higher the score, it indicates that your business is more likely to pay their bills on time, and that should increase your chance of obtaining funding. One of the reasons that you should check your business credit score, the mistakes happen. If there's wrong information on your credit score, then it does not show a true picture of your business health. Your business credit could get mixed up with another business with a similar name. One of your vendors or lenders could report that you missed a payment or were late. Any number of things can happen that affects your score. If you don't check it regularly, there's no way for you to know if those things occur. As I was editing the video, I failed to mention where you can find the information to look up your business credit report. So if you go to Dun & Bradstreet, dnb.com, it'll take you to the head page, and there's different options that you can get to protect your business, or at least to look at the information at your business. So click Get Started, and it'll give you 3 different types and 3 different fees. The free is going to just give you what your score is and how many inquiries you have, and then you can go up from there. Really, depending on the size of your business, it probably wouldn't be a bad idea to have some sort of monitoring and to see what accounts are out there. But this is Dun & Bradstreet. They're pretty much the gold standard in the business credit reporting space. So just want to put that out there. Now back to the video. You also want to check to see if your credit score changes every time new information is reported. This could either be from your lenders or your vendors, and so that would affect your score also. There's also a risk of fraud. Business credit fraud and identity theft is a growing problem, and it's only increased since the pandemic began. And you want to make sure that none of that negative information goes on your report. It can also help you look out for suspicious activity for things that are listed on your report. Just like your personal credit report, the higher your score, the lower interest rate you're going to pay on debt. So now that you know that they're important, the best way to increase your business credit score is to make sure you're paying your bills on time. Building credit doesn't have to be difficult, but it can be confusing at times because not all the bills you pay will show up on your credit report. So any account that doesn't show will not help to build credit. Try to only open accounts that will report to your business credit history and make sure that those accounts are current. So now with the business credit score out of the way, let's get into how your personal credit score affects your business. If you haven't been in business for very long, the lender or bank is only going to look at your personal credit report. If you're going to get an SBA loan, they will pull an SBSS score for your business. If you are a startup, the SBSS score will be based on your industry and the probability of default within that industry. If you've ever been denied a loan in the past, you have been sent what is called an adverse action notice. Basically, this is explaining why your creditor rejected your loan application. Most of the time, it will include many reasons that are shown on the personal credit report. These come with a number and they're considered reason codes. Your lender must show up to 4 of these reason codes if they decided not to approve your application. Not all of these codes are equally weighted the same, and depending on which reporting agency your bank or lender uses will determine which codes are used on the report. Some of the ones that cause the biggest red flags for lenders are going to be delinquent accounts or derogatory public records. This means that you have bills that were left unpaid for 30 or more days and are considered delinquent. Derogatory public records refer to bankruptcies, civil judgments, tax liens. These will be some things like not paying your water bill and eventually it goes to collections. Even though a bankruptcy may be discharged, a judgment settled, or a tax lien paid, but if it happened recently enough, the event will still have a factor on your credit scores. and most likely is going to be a hard no from your lending institution. You could also have things like lack of recent loan account information. This basically just means that you don't have a lot of accounts, such as credit cards or other types of loans that are considered installments. Another one of these would be car payments. Your credit score benefits by having a mixture of these types of accounts. I'm not saying going out and opening a whole bunch of accounts just so you can increase your credit history, because it's also going to look negatively like you're actively looking for credit. But it's good to have a mix between car payments, credit card, things like that to help you build credit. Another category is amount owed on accounts is too high. This code is an indication of how much debt level you carry. If your installment loan balance is too low, this will cause your score to be impacted. If you go to Best Buy and buy a new TV, surround sound system, gaming system, TV, all that, and it costs you $2,000 immediate, you will have an installment loan of $2,000 with a balance of $2,000, giving you an extremely high usage rate. Or similarly, if you pay your credit cards off monthly, but you do it after the date that the credit agency reports, it's going to look that your credit cards are maxed out and that your available balance isn't that high. How long your accounts have been established. If you have a lot of new accounts that you open, all that's going to factor in and give you a low average age, and that can drag your score down also. And the last one that puts up a flag for any lender is going to be too many account inquiries. This one's pretty straightforward, and it looks like you've been shopping around, and the time span between the last time you applied for credit is very short. This is why my recommendation is when you go to buy a new vehicle, get a pre-approved letter from a bank or credit union before you go to the dealership. If you go to a car dealership, they're going to send your application to 3, 4, 5 banks to try and get you the best rate, and they're all going to run your credit at the same time. Each one of those could potentially impact your credit score by 10 to 20 points. Based on any of the reasons above, your lender's going to have a pause when they look at lending you money. Derogatory public records and bankruptcies are going to be an immediate red flag, because they figure if you can't handle your personal finances, how are you going to handle your business finances? If your amounts are too high, or if your revolving amounts are too high on your personal credit cards, they could think that maybe you're using the money from your personal accounts to keep your business running. And if there's also a ton of inquiries on your credit report, they're going to wonder why you went to so many places to look for money. Sometimes if you apply for business credit, they won't necessarily show that they ran on your personal credit, and they may do something like a soft pull on your personal credit so it doesn't affect it. But I wouldn't rely on the good judgment of the bank when it comes to your personal credit report. The best way to make sure that you're eligible to borrow money is to keep track of your personal credit and your business credit report, and make sure that everything on there is as accurate as possible. Try to limit the amount of personal debt that you take out at any given time, as well as applying for any additional debt, because it could impact your business's borrowing in the future. I know all of those store cards that offer you great rates or no interest for a year sound like a really good deal. Just realize every time you apply for one of those, it's going to show in your personal credit report. It's also going to show the available balances on the installment payments. So in the same month that you take out a store card and you need to go buy a new vehicle for your business, it may affect that credit decision. At the end of the day, you have to be the one to decide what the best way to finance on the personal and the business side makes sense to you. I wish you the best of luck in your business endeavors. Thank you very much for taking the time to watch this video, and until next time, have a great day.